So Cam, if you don't mind just giving us a little bit of your background and then jumping into the presentation for 10 or 15 minutes, and then we'll do Q&A until quarter two.
Sounds good, Taylor. Thanks. So do you want me to drive screen share from my end?
Yes, that would be great.
I'll do that. Well, before jumping into that, again, I'm Cam Bishop. I'm based in Kansas City. I do have a bit of an unusual career path. I spent about 35 years. I started my career as an advertising copywriter, but kind of moved up the food chain in a media company. We built that to 400 million with 100 million in EBITDA. I ran it for quite some time, and I launched the company with JP Morgan Chase Bank's private equity division. So in my career, I have done about 45 or 50 buy-side transactions, spent over $500 million doing so, another 20 to 25 sell-side deals, spent 5 years as an exit and transition planning consultant, which ties in with my talk here today. Spent 3 years doing a very difficult turnaround on a $60 million 501c3. And then during COVID, I got bored and joined an investment banking firm where I am today. And we help business owners who want to sell their companies nationwide in just about any industry you can imagine, from high tech to construction, business services, you name it. So the advantage and some of the things I'll share for you today here kind of relate to the kinds of things that we see that business owners really don't do well, and what they need to do well if they someday plan to share their companies. So we'll jump into the deck here. All right, everybody see that?
Yeah, it's good.
Okay, good. So one of the key factors for business owners that nobody often thinks of is that most business owners spend about 95% of their time working in the business rather than working on the business. And it turns out to be a pretty significant mistake over time. And that's what we'll talk about here today. So just briefly, a little bit about what the two differences are. We see this all the time when business owners come to us and want to sell their companies. They mostly have run their businesses to extract an end-of-year distribution, make an income, and avoid, legally, of course, paying taxes. And they almost always have minimal accounting. Sometimes it's checkbook accounting where they pay their bills when they look at the balance and they have enough money in the bank to make those payments. But the owners who think long-term and are planning to have run their businesses from a standpoint of obviously being profitable and growing, but from a valuation, they develop a strategic plan long-term, and they have an exit plan for their business, and they need to develop a succession plan for who's going to run the company once they leave. And those are kind of critical factors. We'll dive into those a little more deeply here in a minute. So a few bits and pieces on why it is so important to run your business for the long term. People don't understand how difficult it is to sell a company. About 70% of businesses that go to market never sell. And there are a lot of factors that we'll talk about on the next slide. And one of the criteria for the reasons they don't sell is people who are buying companies are extremely particular. Essentially, everybody wants a unicorn in their business. But the reasons to have a succession plan and an exit plan are that one way or another, everyone will leave their company. They're either going to do it voluntarily standing up, or they're going to go out in a box. And we see tragically a lot of cases where there was no exit plan, the owner passes away, and the business kind of oftentimes goes into chaos and becomes unsellable, or they leave other family members with a pretty significant set of problems that have to be cleaned up. Also, the more advanced planning business owners do in terms of being prepared to sell their companies down the road is based on how much work they do up in advance. Because even at the time of selling a business, Selling a company is extremely difficult and a lot of really hard work, even when you are working with a series of business professionals, that's an M&A attorney, some type of a business broker or an investment banker, tax advisors, etc. Selling a business is generally and almost completely a full-time job on top of the full-time job that you have actually running the business. And those are important things to always be aware of as you think about the future of your company. And of course, there are the 5 Ds, which are the primary drivers around why businesses end up being sold. Either somebody dies or there becomes a disability. There's a distress situation inside the company. There are disagreements among owners of the company, or oftentimes, unfortunately, there can be a divorce. But these things do occur, and it's always best to be fully aware of these potential downsides and prepare for them well in advance. Now, kind of the key takeaways today for you that I think are really important, and as an investment banking firm, we derive most of our clients from inbound lead generation. So business owners find us and come to us and when they want to sell their companies. And in preparation for this discussion today, I went through my records. So far this year, I have spoken with about 77 business owners, and only about a handful of those are actually sellable companies because they have not followed the criteria that I'm recommending that you consider in your own business as you place some degree of focus on working on the business as opposed to, kind of the typical day-to-day of working in your business. So what are the factors that you can do to improve your business and make it far more valuable? And the inverse of that is to make it sellable versus non-sellable. So probably the number one worst problem we see in companies is, frankly, terrible accounting practices. They either don't keep good records, they aren't professionally kept, they don't have balance sheets, they don't have cash flow statements. Most times they don't even understand what accrual basis accounting is. But even if it's kept on a cash accounting basis, they need to be accurate records. If you're in a type of business that has to maintain inventory, then it's extremely critical to manage and track that inventory, especially from a raw goods standpoint. We run into tremendous issues around businesses, especially manufacturing companies in particular, which have a lot of raw materials they're going to convert to a finished product. The number 2 challenge we see with businesses relates to owner dependency. In so many cases, the owner is the founder of the company. They own customer relationships. They're the key knowledge holder in the business, and they haven't begun, or they're extremely reluctant to delegate and train and bring along a number 2. A lot of times that's because of the cost factor, but other times it's strictly an ego factor. And when businesses are sold, if the business owner is the key dependent factor in the company, buyers either won't buy the business or they will heavily discount the purchase because they see tremendous risk, especially if that owner is the key stakeholder in customer relationships. They're doing most of the selling. The key litmus test is if the clients have the owner's cell phone number, then that's a heavy owner dependency on a customer standpoint, from a customer standpoint. But there's other levels of dependency. If you have some kind of a critically talented individual in the company that is unique for engineering skills, for example, or some technical expertise or knowledge, if the business is highly dependent on that individual, buyers see that as a huge risk factor. There are ways to work around that through incentives for that individual, but it's important to understand that these are factors that you need to evaluate in order to maximize valuation or just to have the company be sellable. If the business is dependent on a few customer relationships, that it can be a critical factor as well. As I mentioned earlier in this call, some type of succession planning and training for a successor, someone who is ready to step into your shoes when you want to exit the business. Those are key value enhancers. Another huge criteria we run into is customer concentration. I'm representing the owner of a business right now that has a fantastic business, but 80% of his business comes from one customer. And this is a $20 million company. It's a long-term client, but the contracts are evergreen, and buyers are going to look at that, and it's going to be a problem. So it'll probably create a sales structure, which is not ideal for the owner of the business, some time of long-term payout on guaranteed continuation of sales with limited cash on closing. So having a diversified customer base with no client representing more than about 20% of your business is kind of the ideal threshold from that standpoint. Customer churn is another key factor. If there are no long-term retained clients and they're constantly turning over, this can be a red flag for buyers. The same factor can occur on the vendor side of things. I represented a Canadian client last year who was 100% dependent on their raw goods material that they used from one vendor, and there wasn't really a secondary backup, and there were no concentration, or there was no contracts in place, and we couldn't get buyers to the table because of that huge risk factor if that vendor decided to walk from our client. You can underinvest or overinvest too much. In businesses that have a lot of capital equipment in their companies, we've seen companies pay way too much for additional equipment in order to avoid paying taxes. So buyers of businesses think that's going to be the necessary requirement, and that reduces the cash flow on the business. Therefore, they have to service debt when they buy it, so they're willing to pay less. The same on the inverse side. If you try to squeeze too much life out of existing capital equipment, buyers are going to look at that. They're going to look at maintenance records, and they're going to determine they're going to have to pay less because they're going to have to go out and buy a lot of capital equipment. Too much debt, that one kind of goes without saying. When you sell your company, most companies are sold on a cash-free, debt-free basis. So you'll take all the cash off the balance sheet, but you'll have to pay off all the debt. We've seen a number of cases where the debt on a business was worth more than the business. So if we sold the company, they would literally end up underwater relative to business valuations versus the debt they have to pay off. Kind of tied in with bad accounting, it's really important to develop some kind of a basic strategic plan. Forecast your business, use your financial records as a strategic tool, and try to develop some kind of a budget that you can follow, because most buyers look for that in a business. Little or no reoccurring revenue. On our breakout call, I heard something about reoccurring revenue, and that is a highly valued factor for businesses today. For example, HVAC companies today are in high demand because so many of them sell service contracts to their customers, and that gives them the opportunity to go and service air conditioners and furnaces once or twice a year at the most, but they're getting that monthly reoccurring revenue, and it gives them the opportunity to remain customer facing with that vendor. If there are no contracts in place, that gives buyers what my mother used to call the heebie-jeebies. So if you can document your contracts on both sides, those are important. If you do have contracts, try to make certain that there are no what are called assignability clauses, meaning that if you sell your business, the person or business you have that contract with has the right to cancel that contract. And that can be a huge last-minute hurdle in deals. Making a decision at the last minute to sell, which we see all the time. Business owners just wake up and say, hey, I want to sell my company. because the ideal situation is to plan for that 1 to 2 years in advance, so the business can be well groomed again to optimize your valuation for the company. You always want to have a focus on growth, because a business that is stagnant or declining, again, those just set off red flags. And if buyers are willing to buy, they're going to heavily discount against the risk factors around that. Same goes with profit margins. If you're not managing pricing relative to cost of goods or other similar criteria where your profit margins are declining, those are factors that are going to cause buyers to either not want to participate or to reduce their purchase price on the deal. Final one goes for a high rate of employee turnover, especially in the market dynamics we're in today, where the vast majority of business owners that come to us and want to sell, their primary driver today is around employee problems relative to finding talent, retaining talent, or properly compensating talent. So your corporate culture, your compensation structures are all very relevant to value creation in your company. I know we'll get in Q&A, and I know we have a shortage on time, so I'll just touch on this last one before we go into Q&A. This is something a lot of business owners simply don't understand. Just because you can make money with your business, and sometimes make a lot of money, it actually doesn't mean that your company is sellable. And I've listed a number of criteria, which again, in the interest of time, I won't go through here, but I would encourage you to kind of study these factors. I would say the one key thing that we hear often, I get a business owner who runs a consulting company of some time. They have some special knowledge or expertise. They are a one man or woman or 2 or 3 employee shop, and they want to sell that business. But that business is not sellable because that's a business that is entirely dependent on the knowledge of that individual. And that's what is commonly called a lifestyle business. Again, I've seen a lot of the consultants with a practice where they're making tons of money, but it's not transferable based on the knowledge dependency of that business owner. So happy to turn it over to the group for any questions or discussion you might like to have.
Awesome. Thanks, Cam. One question from Matt in the chat. Can you comment on companies that have no employees where everyone is a 1099 contractor?
Yeah, we see that a fair amount, especially in tech services kind of companies, digital agencies, marketing agencies. And while that's a model that does work, there's usually a discount on valuation on those type of deals because, and by the way, we use them in our firm too, so I have nothing against it. It's a smart business move in a lot of sense, but it's not necessarily optimum for value creation in a business, because 1099 contractors under the Department of Labor cannot be dictated to or controlled by the client that they work for. So they're often working for multiple firms. They can jump ship in a heartbeat, and that creates a level of uncertainty, and that usually creates a discounted valuation structure for those kinds of businesses.
Yeah, thanks, Cam. I'm not surprised by that, but that's what my business is and has been. It was great when the pandemic hit, I'll have to say, when we had that first 6 months of extreme uncertainty, right? Yeah.
Yeah. Well, again, you can build a great business depending on 1099 contractors, and you can have a great business as a 1099 contractor. When I was a consultant for 5 years, we worked under a branding umbrella, but I was a 1099 contractor. Mm-hmm. And I knew that my business at that time wasn't sellable because it was me.
Right, right. Thank you.
Cam, can you talk a little bit about you mentioned valuation. Can you talk about how you approach or look at companies in terms of how they're valued? I mean, I think we hear a lot about multiples on revenue or multiples on EBITDA or whatever it is. Are there factors in your list there that you shared that are more impactful on valuation, and generally, how do you approach valuation?
Yeah, so again, my first bullet point, it's all going to begin and frankly end with the quality of the accounting reporting. Monthly income statements, monthly balance sheets are essential. Every buyer will want to see those. And they will most likely look back a minimum of 3 years. And the basic way that valuations are created today are on a multiple, on smaller businesses, they're created on a multiple of what's called seller's discretionary earnings. And that's essentially what the profitability of the business is by adding back the income of the owner, as well as any other extraneous expenses that a buyer would not have to incur. On larger companies with a profitability margin defined as EBITDA, earnings before interest, taxes, depreciation, and amortization, those companies generally have $1 million in adjusted EBITDA, and that's the valuation is based on those multiples. And there are I could probably list 40 to 50 micro factors that impact valuation, both inside the company and relative market dynamics. But on a macro level, there are factors that obviously are out of our control. So, very quick example, I'm representing a family business with a $100 million revenue in the distribution of construction materials for the residential home building market. Well, the macro factors in that market are not particularly attractive today. A combination of interest rates at 7 to 8%, the dynamics in various sectors of the housing market where some are strong, like the Southeast, some are weak, like the Northeast, playing into that. The issues with bank solvency recently, those have caused banks to cramp down on their willingness to lend debt leverage on deals, coupled with the interest rates that buyers have to pay when they borrow money to buy a company. They're going to trade that off by paying a lower multiple on a business. So there's a whole variety of factors. And when we're creating a valuation for a business owner, we look at all of those factors on a micro and a macro level, as well as a deep dive into various characteristics that I just described there on any company to determine what a valuation range, a reasonable valuation range would be for a business.
That's helpful. Thanks. Got another question in the chat. Can you speak to the possibilities of an IP or technology sale in the case where you have a valuable tech, but you are forced to move on from it and would like to sell that IP or technology? How would you approach that? And do you have thoughts on how to value it, et cetera?
Well, that's actually an extremely complex answer to that question because it's highly dependent on the technology, on the industry, on the uniqueness of the IP. I've had a couple of groups approach us from that standpoint, and generally those come down to how much demand from a competitor there is for that technology and an assessment of the owner of that IP as to what the upside revenue is for, like, if it's a direct competitor or a tangential competitor or another firm that they can add that on as a product line extension. And that becomes a fairly arbitrary negotiation in any of those cases. But generally, those kinds of situations aren't just sold to an individual buyer or a search fund buyer or a private equity firm. Those are generally sold on a more direct basis between the owner of the IP and the potentially beneficial parties, which they would know most about given their knowledge of that specific technology or industry sector.
That's helpful. I've been capitalizing on the questions, but hopefully hitting the ones in the chat. Anybody else have any questions that they would like to jump in with? Just unmute yourself, or you can throw some more in the chat. I'll pause before my next question, see if anybody unmutes.
Honey, honey, stay long.
I don't think that was meant to be a question. So Cam, if I'm a business owner and looking to sell, what would you suggest the first steps would be to start the process?
Yeah, well, the first step would be to determine what your end game is and what your timetable is. So if you're in a family business, are you going to hand off that business to a family member? Or sell that business to a family member, which happens less and less, especially with business owners who have children. We've seen a dramatic decline in the number of businesses where children of the owner have no interest in either owning or even working in that business. So that used to be a traditional transition process for businesses. If you have a number two in the company who is a viable successor, then training that individual up for a year to 2 years to 3 years is optimum. That gives you two options. You can either sell the business outright, or you can negotiate a deal to sell the business to that individual with a combination of equity and owner financing and some, an SBA loan or some bank debt associated with that. But again, first and foremost is to have accurate, complete, consistent accounting. That's just the number one factor. And then if you just look down those impediments to a sale bullet points and just kind of work through those, understand, as I said, that selling a business is a very difficult, it's highly emotional, it's a tremendous amount of work. So if you plan farther in advance, have good record keeping, have all your contracts in one place, have contracts where they're appropriate, all of those things make a life a whole lot easier for you. And as you look at your timetable on when you want to exit that business, understand from the day that you sign a contract to have someone represent you to sell the company, in a best case scenario today, you're looking at about a 9-month window. And we've been seeing this year those typical 9-month windows stretching to 10, 11, 12 months in that process. So look at when you finally want to be out and back it up from there.
That's very helpful. Thanks. Two more questions, one in the chat, and Rob, I see you raised your hand. Tara's in the chat asks, how much is cybersecurity positively or negatively impacting valuations from your perspective?
Again, it depends on the type of business. If you're in the type of business that is heavily data dependent, then I would highly recommend that you make the investment in a cybersecurity policy under your corporate property and casualty, directors, owners, and officers type of policy, and make the investments in the level of first tier and second tier security that you're going to need in that business.
Okay. Great. Rob, you're up.
Hey, Cam, thanks for the info. Definitely as an entrepreneur, sometimes we think, oh, I'm going to sell my company. It's going to take a couple months, get millions of dollars. Probably that's not the case. Real quick, I just want some strategy. I have a company, I'm CEO of a company. We have really good margins, like 90% margins on our product. We have reoccurring revenue. A Fortune 500 company has contacted us. However, they're just watching. I'm going to maybe do a little strategic partnership with a different company. In the end, when the Fortune 500 company comes back, do they like seeing multiple companies that have come in and taken equity? How does that work out in the end? Is that a positive or negative, kind of in that situation right now?
Well, every situation is a little bit unique. So without knowing a whole lot more about the nature of the partnership, I couldn't give you a definitive answer, but I can tell you generally, that would probably be a complicating factor in doing some kind of a transaction in the process. I think two additional key takeaways, especially for you, Rob. You know, it's a general rule of thumb that if there's one company interested in buying you, there's more than one. And without kind of going into a market-based approach, you don't really know what the market value of your business really is. So there's ups and downsides to that. You can get a faster deal done often, but you won't know if you leave money on the table or not without running a more traditional marketing and essentially an auction process. So a good business broker or investment banker is going to try to bring multiple offers to the table for you. And that gives you a better sense of what the business is worth, because at the end of the day, any business is only worth what a buyer is willing to pay. So if you don't have a reference point or some context of one versus another, you'll always wonder, did I extract maximum value? But it can also be offset by if they're willing to pay you all cash, that may be worth it to you versus a buyer who may be willing to pay more, but wants you to carry back some equity in the business or wants you to defer or take what's called a seller carry note, where they're essentially borrowing part of the purchase price from you and paying it off. In this day and age, it is 6% to 7% interest rate over typically a 5-year period. So those are the trade-offs. But kind of my rule of thumb when I was running companies, and still to this day, is I always believed in know what I knew how to do well and do it, know what I don't know how to do well and hire an expert to do it for me. And if you try to sell your company on your own, and this isn't a pitch for me, you can go to anybody who's got a track record in the transaction world and work with them so that you've got an independent expert in between you as an emotional seller, because everybody's emotional when they're selling their baby, and a buyer who's trying to get the best deal at the lowest price. So that middle person who's an expert more than pays for themselves. Same with an attorney who has expertise in mergers and acquisitions, not just your uncle down the street who does business law or does trusts and estates. Spend the money, hire an M&A attorney. They're worth it.
Awesome, thank you.
And I would also offer, if you've got my contact information in the deck, I am more than happy on a no cost, no obligation, no sales pitch. If you want to shoot me an email and just say, hey, can I get your advice on some things? We do this all the time. Again, I emphasize no cost, no obligation, no sales pitch. It's actually unethical to pitch a business owner to try to talk them into selling their business. But I can and would try to talk you out of selling your business if for some reason I didn't think it was in your best interest.
Awesome, thank you so much.
Cam, you mentioned the deck. Have you sent that to Hannah? Do we have access to that to be able to send out?
Yes, she does.
Okay.
If not, I can easily send it again.
That's great if you've done it. I just didn't know. Last question, James and Cam, if you're okay with spending a couple more minutes answering this question. James says, do you see buyers using a multiple valuation method and then adjusting? Uh-oh, lost my chat, sorry. And then adjusting from there based on issues you raised today? Or do you see more intrinsic value as starting points?
So generally speaking, so I think probably everybody on the residential real estate side of things is familiar with the MLS listings, and you can go in and see other homes in the area that you want to buy a home or where you're going to sell a home, and see generally what those houses are selling for. In the M&A world, there are databases where you can do basically the same thing in different industry sectors. So for example, if you're selling a SaaS platform software business with huge reoccurring revenue, you might get 10 to 20 times your profits for that business. If you're selling a single restaurant with 1.5 million in revenue and $200,000 in profits, you're going to get probably a 1.5 to 2 times your profits for that business. So when we're working with clients, we refer to our databases, we look at the numbers. If you're selling a business in mid-year, the buyers are going to look at what's called TTM revenue and TTM profits, and that stands for trailing 12 months. They're going to look at what you did last year, they're going to look at what you did the year before that, but they're going to work off of your trailing 12-month revenue at the time they bid a valuation for the business.
Great. Thank you, Cam.
Thanks so much, Cam. This has been fantastic. Really appreciate you sharing your expertise here. And I would invite everybody who would like to ping Cam if you've got some questions. We can get you his email if you didn't catch it on that last slide. But thank you, Cam, and thanks everybody for joining. We'll see you all next week and look forward to our next session together. Thanks all.
Thank you.
Thank you.